Hello, everyone. This is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Monday, May 28th, 2024. So what investors are looking for, particularly for the equity markets, is that soft landing. That's the Fed's goal. That's what investors want. So the soft landing is slower economic growth, certainly that we had in the fourth quarter last year at 3.5%, and even probably slower than the first quarter at 1.6%. But not negative, and in addition, inflation that is lower than it is today, which is over 3%. And we will get a key inflation measurement this week. Spoiler alert, we'll talk about that in a few moments. But also key to the U.S. stock markets continuing to work is corporate earnings. We've talked about that. The first quarter was really good. So the expectations coming in for first quarter earnings for S&P 500 component companies was a combined EPS increase year over year, the first one in almost a year, of 3.0%, but it came in much better at 6.0%. So in total, almost all the companies have reported now, 98, 99%. And out of those, 78% beat their EPS consensus numbers, 61% beat the revenue numbers, both better than 5-year averages. So that's all good. So the total first quarter, when you roll that all up, is an increase in earnings per share of 6.0%. But the one thing I would caution on, and I was very surprised to see this number, out of that 6.0, out of the 500 S&P 500 companies, NVIDIA by itself increased that number by 2.7%. So strip out NVIDIA and the huge earnings beat that they had in the first quarter, the S&P earnings growth was only 3.3%. So that's not great breadth, and that's a topic we may revisit at some point in the future. So in terms of economic data last week, it was pretty sparse. There wasn't much going on. Existing and new home sales, they both came in lower than consensus. Those aren't real market movers, generally speaking. And given the fact that we hope the economy is slowing a little bit, that's probably good news. However, the durable goods and durable goods ex-transportation numbers last week were actually stronger than expected. So durable goods for the month of April, it was up 0.7% versus March, and it was actually expected to be down 0.8%. And then durable goods ex-transportation was expected to just barely be up 0.1%, came in at a positive 0.4%. So expectations for GDP growth here in the second quarter, the Atlanta Federal Reserve, their number based on all the information we've just talked about, they moved their estimate down just slightly, was 3.6%, and now is at 3.5%. And again, first quarter was 1.6%. So markets really, I don't think, really want to see a reacceleration in GDP growth. So hopefully we're not running as hot as the Atlanta Federal Reserve thinks that we are at this point. A couple of other items of note last week. Inflation expectations didn't move at all. It's at a very low level. The 10-year expectation for average inflation rate, 2.32%. That's been pretty static most of this year. Hasn't moved a dramatic amount. The other thing is in terms of Fed fund rate decreases by the Federal Reserve. The next meeting is on June 12th, starts on the 11th. They'll announce it on the 12th. No expectation whatsoever of a cut or an increase, 99.1% chance of nothing happening. But then it is interesting to take a look at what happened to expectations for the end of the year. They actually came down in terms of interest rate cut expectations. Now recall coming into 2024, the market had priced in 6 Fed rate cuts. The Federal Reserve, their dot plot had only shown 4. And now at this point, it's not 6 rate cuts investors are expecting. It's really less than 2 at this point. In fact, the odds of no cut at all last week increased. The prior week, it ended the week at 10.8% probability of happening. Now that's up to 17.2, and the expectation of at least 2 rate cuts, that came down last week. It was 56.7 the week before. It came in at 41.5. So investors' expectations continue to sink in terms of the Federal Reserve coming to the rescue and cutting rates. I think that's probably a good thing for all investors. So the markets last week, how did they respond to the news that I just shared with you? pretty much a yawn pre-holiday. Not much happened. S&P 500 very much flat for the week. International stocks down a little bit. U.S. bonds down a little bit. Just nothing really stood out. Tech here in the U.S. continued to be very strong. That's about the only thing that stuck out. The NASDAQ was up 0.75% last week. But other than that, nothing really stood out. Growth was down 20 basis points. Value was down 1.3%. Large cap was barely above water. It was up 9 basis points. Small cap down 150. So those are the gives and takes in the week, but it was relatively not much movement. In terms of the international, so developed markets ex-US, they were down 50 basis points last week. Emerging markets, which has been rebounding, and we keep mentioning the fact that the Chinese equities have really had a very nice rally since March when their government instituted certain measures to kind of prop up their stock market. They gave back some of those gains last week. So the China market last week was down about 4.2%. And now year-to-date, still up a very solid 10.8%, while the S&P 500 is up 11.9%. So emerging markets last week down, well, round down 1%. Fixed income last week, we had the 2-year yield rise 12 basis points. We had the 10-year rise 2 basis points. So the Bloomberg U.S. Aggregate Bond Index for the week was down 0.17%. And now on a year-to-date basis through last Friday, that Bloomberg U.S. Aggregate Bond Index is down we'll call it 1.7%. In terms of economic activity coming up this week, there's some news on Thursday, nothing big. Estimate revision for first quarter GDP that hardly ever moves the market. Jobless claims, unless it's an outlier, that won't do anything. Pending home sales, nobody pays attention. So Friday is a big day, though. Friday is big because the number one metric being looked at by investors, inflation, and what the Fed might do as a response. So we have both PCE and core PCE, personal consumption expenditure, being reported for April on Friday. And again, we always mention this, Federal Reserve uses this measurement of inflation for policy-making decisions, not the CPI. So PCE is expected and core PCE both expected to come in month over month at a positive 0.3% or 12-month run rate of 3.6%. It's exactly what we saw the month before, so no change is expected, which I think would be a little disappointing. Investors obviously are hoping for some improvement in inflation. We had nice improvement for a year and a half in the last 3 months, have been flat to up. Now, 2 other metrics that come out on Friday, which work both ways, personal income and personal spending. So personal income still expected to show growth in the month of April, but only up 0.3% month over month. In the month of March, it was up 0.5%. And personal spending, and this one, of course, hits very directly at inflation, that is expected to come in month over month at 0.3%, much more moderate than what we saw in March when it was up 0.8%. So that's it for the economic data coming out this week. A recap of last week and how markets reacted to all that. We thank you very much for watching and hope to see you again next week. Thank you.